Hello, my friends. Today is April 27th, and this is Markets Weekly. So, this week was another volatile week in markets, but we did end the week up nicely. It looks like that 100-day moving average provided some good support for the S&P 500, and now we're right below the 20 and 50-day moving average, which I'm sure many bears would like to sell at. So I think that the short-term trajectory of markets is going to be heavily dependent on the big events next week. We got the Fed, we got the quarterly refunding announcement, and we got non-farm payrolls. As you all know, I continue to be positive on the equity markets. So today I want to talk about three things. First, we have to talk about the big data prints we got the past week that seem to suggest that inflation is going to be sticky around 3%. That is, as we've been discussing for months, disinflation was transitory. Secondly, so it looks like the US government is poised to seize Russian reserves and give them to Ukraine. Now, I think this is a very big development in the history of the monetary system, and it's going to have big impacts that will be felt for years and also have big impacts on asset prices. Let's talk about what some of those impacts could be. And lastly, so last week, the Fed published its most recent semi-annual financial stability report, and in it is full of lots of interesting data on valuations and credit quality as the Fed staff sees it. So let's take a look inside to see what it's saying. Okay, starting with the big data prints. So the past week, we got the first estimate of first quarter GDP, and on the surface, it doesn't look good. So GDP growth printed at 1.6%, which was not just far below expectations, but also below trend. Secondly, inflation printed above expectations and looks like it's going to be comfortably above 3%. So all in, it looks like growth slowing, inflation accelerating, smells a little bit like stagflation. But I think below the surface, it looks a little bit better. First, let's talk about GDP. So GDP, obviously 1.6%, a big disappointment. But the people who really study this say that, this GDP print is actually stronger when you look below the surface because GDP is comprised of many different components. Some of them are quite volatile. Kind of like CPI, you have, headline CPI that includes things like energy, that is, goes up and down, and you also have core CPI that excludes these volatile components. When it comes to GDP data, these volatile components are things like net exports and inventories. So when you exclude the stuff that's more volatile, looking at the core measures, let's say private final consumption, it looks a lot better, and frankly, it is decelerating, but it's still historically quite strong. And so a lot of the people who focus on this don't actually think that this was a weak GDP print. In fact, you can even make the argument that demand is quite strong in the US, so much so that it's spilling over and leading to more imports. And maybe the stronger dollar plays a role as well. So again, maybe the GDP print is not as weak as it appears to be. But the inflation print, though, is very, very clearly disappointing. So just to level set a little bit, for the second half of 2023, core PCE printed at bang on 2.0%, and now it looks like it's comfortably above 3%, at least for the first quarter of this year. Now, this is really eliciting a very strong market reaction. Because if you think that, GDP continues to be strong under the surface, but inflation looks to be accelerating, then obviously it's going to have big impacts on monetary policy. The Fed just can't cut as much as it wanted to. So the reaction to this news is, yields going higher, market pricing out Fed cuts, and of course, equities selling off. Right now, it looks like the market is pricing in, just maybe 1.5, a bit less than 1.5 cuts this week. And I think that makes sense. The Fed's projections for this year was to end the year at about 2.6% core PCE and 3 cuts. If core PCE looks to be above 3% this year, and right now that's the trajectory, you definitely can't have 3 cuts. You can have 2, you can have 1, and something like that. So I think the market is bang on for that. But note though, this is a very volatile series, and we could have different inflation prints, we could have weaker employment prints, and there is some indication, looking at, say, PMI data, looking at wage growth, that the labor market is softening. We can have weak labor prints, and that would completely change the calculus. But right now, it looks like we're going to get a more hawkish Fed than before. Jay Powell's pivot when he was at that conference in DC chatting with Governor Tiff Macklem of the Bank of Canada was prescient, and maybe he knew in advance. Now, so I think the Fed meeting this coming week is probably not going to be too surprising. The market is already pricing in a lot of hawkishness. Okay, the second thing that I want to talk about is that the House recently passed a resolution that will allow the US to take the Russian reserves that it seized and give them to Ukraine. Now, this is expected to easily sail through the Senate and be signed by President Biden. So it's going to happen. Now, at the end of the day, this is only a few $billions. Most of Russia's foreign reserves are in the Eurozone. And the Eurozone, there's discussion that they want to do the same thing, but there's, I think, a little bit more uncertainty. Now, I think this is a really big deal because it's telling the world that, your money in dollars just isn't safe. If we don't like what you do, not only are we going to freeze it, when you freeze someone's assets, there's still hope that maybe later on a new government comes and then you can release the assets, or maybe you modify your behavior and the assets get unfreezed. But they're taking assets from one country and giving it to another. Now, I think this is really going to have a big impact in how sovereigns, like other countries, especially those that are not close friends with the U.S., think about holding their financial exposure. Now, today, the U.S. is the world's global reserve currency. Everyone holds a bunch of treasuries, a bunch of dollars, but that didn't happen magically. It was the effort of a lot of diplomacy and a lot of good management, which is not the case today. Now, there's a recent paper called the Treasury Standard that I'll link to that details some of the efforts that went into in making the dollar the global reserve currency. The U.S. government, basically went around the world saying, "Hey, we're protecting you. We're doing good things. Can you buy some treasuries?" And that was very successful. You had a lot of countries, let's say in the Middle East, throughout the developing world, feel comfortable buying treasuries, and through the decades just became routine in buying that. But now you're giving people a reason not to buy, not to hold dollars, not to have treasury exposure at the time when you're running a 5-6% fiscal deficit for the foreseeable future. That is to say, when you really want other people to hold your dollars. Now, we hear a lot of news of, let's say, the US is building a new chip factory in Arizona and Texas or wherever. We have Taiwan semiconductors coming in and building factories. There's a big push to build a lot of chip factories in the US. Why? Well, naturally, part of it is due to geopolitics. We know that we are really reliant upon this, and this resource is close to China, far away from our sphere of influence, and there's some conflict over Taiwan. So it's part of a geopolitical play. Now, keeping this in mind, you have to think about this from, let's say, China's perspective, right? So the U.S. is trying to diversify from China through what it's reliant upon, manufacturing, friendshoring and things like that. And China is going to be doing the same thing. It has tremendous amounts of dollar exposure. Now, we don't exactly know just how many treasuries it holds. Its foreign reserves, about $3.5 trillion. Again, the exact composition is a state secret, but generally estimated to be at least $1 trillion. And that's a lot of exposure that, just as the US diversifies manufacturing away from China, China is going to have to diversify some financial exposure away from the dollar. There's not a lot of places to put that money, but we know that they've been trying to put it in other places. For example, there was that, say, Belt and Road Initiative trying to lend dollars to a lot of developing countries. So basically, your dollar asset goes from an asset that goes from an IOU given from the U.S. government to an IOU given by another government, which doesn't have as much credit risk. So it seems like one implication of this big diversification of foreign reserves is going to be a bid for non-dollar assets like gold. So if you look at some of the data, it looks like a lot of the surge in gold prices is due to increased activity trading in China. And you even have some data that suggests that maybe there are a lot of people in China stockpiling things like copper. So if you have $1 trillion of exposure and you want to diversify that a little bit, one, there's not a lot of things you can do, but when you do it, you have to do this slowly, and you're going to make prices rise. Now, looking at the gold market, it's big, but it's not that big. It's not that liquid, and it really can't hold that much money. So when we see the steady bid in gold prices, even as the dollar strengthens, even as real interest rates rise, I'm getting the sense that you really do have some sovereign interests there trying to diversify their tremendous holdings, and they have to do it slowly and gradually because the market in gold is just not that deep compared to, say, treasuries. So I'm feeling pretty positive about gold prices right now, that it can really go higher than anyone expects, simply because you have these real geopolitical interests at play. Now, on the flip side, though, we could see structural weakness in treasury market going forward, simply because we are widely advertising to a lot of foreign investors, foreign sovereign investors, who, is a big pool of money, that dollars are not reliable, because if you do something we don't like, we're going to weaponize it against you. So I think this is again, plays into a theme of maybe higher interest rates, not just due to structurally stickier inflation, but that you are going to have more of a risk premia in dollars that you didn't have before, which is a real shame, because having a reserve currency is a huge privilege and part of the reason why the U.S. can just kind of spend without any afterthought. But that looks like it's structurally changing. It's not going to happen overnight, but you're going to have higher commodity prices, I think, and you're going to have higher interest rates going forward over the years. Okay, the last thing that I want to talk about is that the Fed's latest semi-annual financial stability report. Now, this is a really good report because the Fed has really good data, and it's able to organize that data and present a coherent picture as to what's happening in the financial markets. Now, first, let's look at how the Fed staff is looking at valuations. Now, when you look at valuations, you have a textbook approach that is either a fundamental view, let's say, price earnings, stuff like that, or you can value it from a relative perspective, let's say equities versus bonds, something called the equity risk premium. Now, looking at the Fed staff's work, they're saying that, valuations are stretched, which is kind of no surprise to anyone, but also note that, looking at these charts, what is expensive can continue to become even more expensive, and what is cheap can continue to become even cheaper. So personally, I don't find valuation measures to be very useful in looking at markets. But in line with, let's say, perceived expensive equity markets, we can also look at the corporate bond market, and it also looks pretty rich as well. So the way that people usually look at corporate bond markets is what are corporate bond yields as a spread to treasuries. The wider that spread is, the more premium a lender is wanting to receive when it's lending to the private sector. Now, corporate bond spreads are historically quite narrow. So you got narrow corporate bond spreads, high equity valuations. It tells a picture that financial conditions are not super restrictive, which is what we all know. Now, I also want to take a look at what the Fed staff is thinking about when it comes to housing. So one valuation metric of housing is to basically look at house prices with reference to rents, kind of like a cap rate approach of looking at it. And based on this measure, their calculations suggest that home prices are historically quite high, which is in line with what many people are thinking as well. Now, moving forward, let's look at some of the measures of credit quality. So there's been a lot of discussion how the U.S. consumer is just not doing that well. So here we provide, first, let's look at auto loans. So looking at auto loans, we see auto loan balances really surge post-pandemic as interest rates were low, and now that they're high, we can see them really plateauing. But more notably, though, we do see that auto loan delinquencies have climbed, and they are higher than they were in the pre-pandemic era. So there is definitely some segment of the consumers who are having some trouble making their payments. Now, looking at credit card debt, we can see that credit card debt, of course, rose a lot, but credit card delinquencies are also climbing. They were at very low levels post-pandemic, but now they are really comfortably above the pre-pandemic trend. So there are definitely some people who are having some trouble making their payments. Now, part of the reason for these rising consumer delinquencies, though, is, as we've discussed before, not so much loosening credit standards, but an inflation in credit scores. Credit scores basically are pro-cyclical. So when the economy is doing well, everyone has jobs, everyone makes their payments, or when, the government is sending you free checks, you have plenty of capacity to make your payments, and so your credit score goes up. Now, this has led to some inflation in credit scores such that, someone who is actually a bad credit looks like a less bad credit. And so, in a sense, you can think of it as basically people who shouldn't be getting loans are getting loans. And I think that's contributing to the higher delinquency rates. So definitely something to focus on. So this week is a Fed meeting week. And so, again, I'll be back on Wednesday to give you my FOMC debrief. But anyway, that's all I prepared for this week. Thanks so much for tuning in. If you're interested in my thoughts, take a look at my weekly blog, fedguy.com. This week, I will be writing about the implications of the policy implications of what we're hearing, that President Trump wants to play a bigger role in setting monetary policy, and maybe he wants to devalue the dollar as well. Let's think about how that could happen and what that implies. And of course, if you're interested in learning more about financial markets, check out my online courses at centralbanking101.com. Thanks so much, and I'll talk to you guys soon.